What if I told you that this week, American stocks ripped to new highs, oil exploded nearly 9% higher, and somehow, the two assets that are supposed to protect you when things get wild, bonds and gold, both got absolutely crushed at the same time? That contradiction right there is the single most important signal in global markets this week. And if you don't understand why it happened, your portfolio could be sleepwalking straight into a trap. Let me break down exactly what just went down across every major asset class, why the dominoes are falling in this specific order. And in a few minutes, I'll show you what this bizarre divergence actually means for your 60-40 portfolio, your retirement account, and the way you should be thinking about allocation heading into one of the most data-heavy weeks of the entire year. Let's start where the headlines are loudest. The S&P 500 closed the week at 7,230, gaining nearly 1%. The Nasdaq did even better, climbing 1.12% to 25,114. The Dow added about 0.5%, landing just a hair under 49,500. And the Russell 2000, our small-cap bellwether, jumped almost a full percent too. Across the board, green, markets hitting highs. Apple dropped a record quarter and announced a $100 billion share buyback that sent the stock surging and dragged megacap tech higher with it. Broadcom entered a buy zone. The mood, greedy, literally. The sentiment index printed 66.6 out of 100. We are firmly in greed territory. But here is where it gets really interesting. Because while stocks were celebrating, the bond market was telling a completely different story. The 10-year Treasury Yield climbed to 4.38%, rising 1.58% on the week. The 30-year yield pushed to 4.97, knocking on the door of 5%. Now remember, when yields go up, bond prices go down. And sure enough, the TLT, the long-duration Treasury ETF, dropped 1.27%. The aggregate bond index fell almost 0.7%. Even high-yield corporate bonds slipped about 0.5%. Every single corner of the bond market bled red. Now think about that for a second. Stocks up, bonds down. That is not what happens in a normal, calm market. In a normal world, those two move in opposite directions because they are supposed to balance each other out. That is the entire premise of the 60-40 portfolio. But this week, if you were sitting in a classic balanced allocation, your equity sleeve helped you while your bond sleeve hurt you, and the net result was a whole lot of nothing. I am going to come back to this in a moment because the implications are massive. Now let's talk about the wild card that nobody on your social media feed is discussing enough: crude oil. West Texas Intermediate surged 8.58% this week to $102.50 a barrel. That is not a normal weekly move. That is a face ripper. And the catalyst, geopolitics. Trump made headlines saying he was not satisfied with Iran's latest proposal for talks, even as a war powers deadline arrived, and he simultaneously declared the Iran situation terminated. Markets do not like ambiguity. And when the world's most important commodity, the one that feeds into the price of literally everything you buy, spikes like that, it sends a shockwave through every asset class. Here is the domino effect. Oil spikes. Inflation expectations rise. When inflation expectations rise, bond investors demand higher yields to compensate. Yields go up. Bond prices go down. And gold, the asset that is supposed to shine during uncertainty. Gold futures dropped 2.05% this week to $4,625. Why would gold fall when geopolitical risk is rising? Because real yields, that is the yield you earn on a treasury bond after subtracting inflation, are climbing. Gold pays you nothing to hold it. When the alternative, safe government bonds, starts paying you more in real terms, gold becomes relatively less attractive. So gold sold off even as the world got scarier. That is not a contradiction. That is the bond market reasserting its gravitational pull on everything else. Real estate. The Vanguard Real Estate ETF barely squeaked out a gain of 0.8%. Defensive sectors like utilities and consumer staples were up modestly too, about 0.8 and 1.13% respectively. Nothing dramatic. These sectors are treading water, not leading. And globally, the story is all about energy prices and the ripple effects they create, especially for emerging markets that import oil and are now staring at wider trade deficits and hotter inflation. All right, now let's get into what all of this actually means for your portfolio, because this is the part that matters. The single biggest takeaway from this week is that the traditional hedging relationship between stocks and bonds is not working the way most people expect. Stocks went up, bonds went down. If you are relying on the classic 60-40 split to protect you, you need to understand that in an environment where inflation fears are resurfacing, driven by energy prices or anything else, stocks and bonds can move in the same direction from a risk-reward perspective. Your bonds do not cushion the blow. They add to it. This is not the first time we have seen this. It happened in 2022. It happened in the 1970s. And the pattern tends to emerge when markets begin to price in stickier inflation or a Federal Reserve that might need to keep rates higher for longer. With the 10-year yield now at 4.38 and the 30-year knocking on 5%, the market is telling you it does not believe rate cuts are coming anytime soon. Now let's talk about rotation signals. The Nasdaq led this week, up 1.12% versus the Dow's 0.5%. That tells you growth is still in the driver's seat. Apple's monster buyback, Broadcom entering a buy zone, memory chip prices surging and lifting names like SanDisk. The tech narrative is alive and well, but the Russell 2000 also gained nearly 1%, which means small caps are not being left behind. This is not a narrow rally, it is broadening. And broadening rallies are generally healthy. They suggest confidence is spreading beyond just the mega caps. But here is the kicker. When oil surges nearly 9% in a single week and yields are climbing, that broadening rally faces a headwind. Higher energy costs compress margins for small businesses. Higher yields make it more expensive for companies to borrow and for consumers to finance purchases. The strength you see in equities right now is real, but it is running on a track that is getting slippery. The sentiment reading of 66.6, firmly in greed, confirms that markets are leaning bullish. And historically, when greed gets elevated while bond yields are rising, that is when you want to be most alert, not most complacent. Gold's decline this week might also be a signal worth watching. For most of this cycle, gold has been on a tear, pushing well above $4,000. A 2% pullback does not break the trend. But if real yields continue climbing, meaning the Fed stays hawkish and inflation expectations moderate, gold could face sustained pressure. The question is whether oil at $102 keeps inflation expectations elevated enough to offset that. We are in a tug of war. And right now, the bond market is winning. So what do you actually do with all of this information? First, let's think about how a balanced portfolio performed this week. A classic 60-40, 60% in equities and 40% in aggregate bonds, would have netted you roughly a gain of about 0.3%. Your stock sleeve earned you about 55 basis points of contribution, while your bond sleeve dragged you down by about 28. You made money, but barely. An all-weather style portfolio that includes gold, commodities, long-duration bonds, and equities would have performed even more ambiguously because gold fell. Long bonds fell hard. And while oil spiked, most investors do not hold direct crude oil exposure. This is exactly why the past few years have forced a rethink of portfolio construction. When bonds and stocks are positively correlated during inflationary regimes, you need alternative diversifiers. Things like commodities exposure, trend-following strategies, or even just higher cash allocations to dampen volatility. Second, defensive positioning. Utilities and consumer staples were both positive this week, but they are not leading. They are surviving. If you are overweight in defensives thinking they will carry you through, they are doing the bare minimum. They are a parachute, not a jetpack. Third, rebalancing. After a week where equities gained and bonds lost, your portfolio has naturally drifted slightly toward equities. If you are a disciplined rebalancer, this is the kind of week where you make a note. You do not need to act on small moves, but if this pattern continues for another few weeks, you may find yourself 5 to 7% overweight equities without even realizing it. Drift is silent. It accumulates. Now, the two things you absolutely must watch next week. Number 1, Friday's non-farm payrolls report and the unemployment rate. If the labor market is still running hot, that reinforces the narrative that the Fed keeps rates elevated, which means more pressure on bonds, more pressure on gold, and potentially a ceiling on how far equities can run. Number 2, the ISM Services PMI on Monday. Services are the backbone of the American economy. If that number comes in strong with rising prices paid, it will pour gasoline on the inflation is not dead narrative. Between those two reports, plus JOLTS job openings data and Michigan consumer sentiment, next week is absolutely loaded with market-moving catalysts. Let's zoom out now and put this week into the bigger picture. We are in a market regime where the economy refuses to slow down meaningfully. Corporate earnings are strong. Apple just printed a record quarter. Buybacks are enormous. The labor market appears resilient, but the cost of that resilience is higher for longer interest rates, elevated energy prices that could reignite inflationary pressures, and a bond market that is not giving investors anywhere to hide. The 10-year at 4.38 with oil at 102, and the 30-year flirting with 5% paints a picture of an economy that is running hot, maybe too hot for the Fed's comfort. Geopolitically, the Iran situation adds a wild card. Energy supply disruptions, even the threat of them, can move oil 20 or 30% in a matter of weeks. And when oil moves, everything else follows. We saw that domino chain play out just this week. The Berkshire Hathaway annual meeting this weekend also marked something symbolic, the spotlight shifting to Greg Abel, a generational transition at the world's most famous investment conglomerate. Warren Buffett's Berkshire is sitting on record levels of cash, which itself is a statement. When the greatest investor of all time is hoarding cash, it is not panic, it is patience. And maybe that is the lesson from this week too. The market is giving you gains, but it is also flashing warning lights. Enjoy the ride, but keep your seatbelt fastened. Here is the bottom line. This week proved that the easy version of diversification, just splitting between stocks and bonds, is not enough in an inflationary, geopolitically charged world. You need to think broader. You need to watch the correlation between your assets, not just the returns of each one individually. And you need to be humble enough to admit that when greed is above 66, yields are surging, and oil is running wild, the next move might not be as comfortable as this one. If this breakdown helped you see the markets more clearly, hit subscribe and ring the bell, because every single week I am here connecting these dots, so you do not have to do it alone. Drop a comment below and tell me, are you adjusting your allocation heading into next week's jobs report, or are you holding steady? I want to hear your game plan. I will see you in the next one.